All right, let me demonstrate to you really quickly how you can find interesting stocks tailored to your risk appetite and build diversified, efficient investment portfolio where your loss always be minimized, potential loss, and your expected return will be maximized. Go to Diverset website and then click here the Diverset, and you have an option to choose among different levels of risk. Risk averse investor is someone who is avoiding risk. Risk seeking is someone who wants higher return, higher risk. And moderate is someone who wants risk but also risk averse investor. Now let me choose risk averse. Then I'm choosing expected return. Let's say I am hoping to get 14% yearly return. Then I press show the result, and Diverset tries to find me the stocks that are tailored to my risk appetite. And let's see what stocks it will offer me. As you can see, these are large cap stocks. I can choose manually. If I press build the portfolio button over here, it will construct the portfolio out of 10 most liquid largest stocks. But now let's choose stocks manually. Please choose 10 stocks for your portfolio. Not less than 10 stocks, not more than 10 stocks. Why 10? Because I think that 10 stocks is the optimal portfolio. If you have more stocks, it would be difficult to monitor them, to undertake fundamental analysis, to restructure your portfolio. If you have less stocks, I think it would be slightly worse diversification. That's why I consider choosing 10 stocks to my portfolio. Now Nvidia is slightly expensive for me. My limit buy order is at 600. Apple I'm not considering right now. Let's say I want to buy Google. It has limited upside on the shorter term, but great support on the midterm. You can see my but express technical and fundamental analysis of Google shares. I will put the link in the comment section. Now let's say you also want JP Morgan shares, Visa shares. Let's say you want Walmart shares. That's 4 already. Let's say you also want Costco shares, 5, Oracle 6, Bank of America. Let's choose the Chevron as well. Let's choose Toyota, Netflix. Let's say Netflix, but ideally you should undertake fundamental analysis of those shares, how to do the fundamental analysis and choose the best stock among its closest peers. I will put the link in the comment section as well so you can see. But for now, for the example, let's choose some of the stocks. Let's choose Adobe as well. Now I press build a portfolio button. And let's see the application build as efficient portfolio, and it says, listen, you wanted 14% initially, but the application Diverset couldn't build an efficient portfolio with 14%, but it says, listen, I can generate your portfolio with 83% expected return, which is higher. You see, it is maximizing your expected return and minimizing the loss, and it is saying if you want this loss and 83% yearly return, which is a lot, you should put these stocks in your portfolio. So 22% should be allocated to Visa, Costco 3%, Oracle 15%, Bank of America 11%. When you see 0, it means you shouldn't put those stocks in your portfolio to get this 83% return. It's very probable right now, given high speculative capital in the market. You can see that larger stocks are trading. They're very volatile right now, and it's quite possible to achieve those results with this allocation. So thank you very much for watching my Express tutorial. This is how you can minimize your portfolio loss and maximize your expected return by allocating your selected stocks assets in the portfolio. Thanks a lot.